In this video, I will show you the 5 filters I use to pick winning stocks. I've been using these 5 filters for almost a decade now, and I have achieved a performance of 25% per year using these 5 filters. So for the moment, they work, and I think they will continue to work in the future because they are inspired by Warren Buffett. In case this is your first video from this channel, welcome. My name is Christophe Nour, and I built this channel to help you become a better investor. So we can start, and I will add some comments along the way. So the first filter you see here is a high return on invested capital. It's only one metric, one line, but it's deadly important because it will remove all the bad companies with a bad ROIC, return on invested capital. What is a high return on invested capital? I would say it's above 15%. If you have a company with a sustainably high ROIC, you can say it's a pretty good business on average. So how you can screen for this high filter? You can go to any screening tool you want. You can use Stock Unlock, you can use FinChat, anything you want, and you can put 15% minimum ROIC for the past 10 years on average. Please use the track record of the company. Don't only look at the last year's ROIC. You have to look at the track record. Past 3 years, past 5 years, past 10 years. Second thing in your analysis of ROIC, is the return on invested capital growing over time or decreasing over time? It's very important. I want to focus on businesses that are growing their ROIC, that are improving their efficiency over time. If you have a return on investment that is improving, that will show you more margins, more efficiency for the business, more rewarding to be a shareholder. So that's a key filter, and it is the reason why I put it number 1, because the goal here is to be a very harsh grader. If a company doesn't have a high ROIC for a sustainable period of time, it's a red flag. It's a red flag for the kind of quality investing I do. And for my track record of investing, of all the investments I've made, high ROIC. High ROIC was the cornerstone of my investment philosophy. I want to invest in efficient businesses. The ROIC is for $100 of reinvestment in the business. How many dollars can you get in 1 year? If you have a ROIC of 50%, you reinvest $100 and next year you get $50. So it's very efficient to reinvest the business. And also the ROIC will tell you something about the capital allocation of the business, if the CEO knows how to allocate capital. Because if you have a high ROIC, like many software companies, for example, you have an incentive to reinvest inside the business to grow at, let's say, 30% per year if you have a 30% ROIC. So you can reinvest all your earnings at 30% per year. You want to see reinvestment opportunities. In the contrary, if you have a low ROIC, it's a waste of capital to reinvest in the business. So yeah, depending on your ROIC, if it's 10, 20, 30, 50%, it's maybe smart to reinvest inside the business, or not smart at all and you will destroy value. That's about capital allocation, and this is very important when you look at companies. But the first point was only this, filter 1, ROIC. Second point is a durable competitive advantage. That's the moat. Without a moat, high profits are temporary. I only invest where the competitive edge is clear and defensible. I've built my track record investing in quality companies, quality assets with a moat, with a competitive advantage that puts this company as being superior compared to competitors. How can you see if a company has a moat? First, you can check the numbers. The ROIC is a good example of how you can see a company has a moat. If you look at all the competitors in an industry and one company has a very high ROIC compared to the rest, that's maybe a sign of a moat. You can also compare the margins, gross margins, operating margins, free cash flow margins, net margins. And if a company in the competitive area has a very high margin profile, has great margins, way higher than competition, maybe they have a moat. You can accumulate all these signs of spotting a moat. That was for the quantitative side. Now for the qualitative side, there are some qualitative aspect of a company that you can spot, like customer retention, for example, competitive edge when it comes to quality of products. Maybe they have economies of scale. Maybe they have special partnerships with suppliers. Maybe they have branding. There are different kinds of moat, of competitive advantages. The goal here for the filter 2 is to only invest in companies that have a moat, that are superior to competition. If you sum everything up with the quantitative analysis, better margins, better ROIC, and also qualitative analysis, better products, better customer relationships, better customer retentions, all these things, you put everything in the same analysis, you can spot superior businesses. Only these two filters can help you spot these opportunities. And this is also what we do on our coaching program. I have a coaching program. This is maybe the first link in the description. You can see more information about this one. The goal, what we do for our group calls, is we spot these opportunities that are superior, and we don't waste any time on inferior businesses. Because if you focus on inferior businesses, you will have an inferior performance. And this is not why you clicked on this video. Third filter is conservative balance sheet. Depends on the quality of management and track record for capital allocation. Yes, the goal is to avoid investing in companies with a lot of leverage, a lot of debt. Now we are living in a world with inflation, with high interest rates. So you will have to pay an interest rate, interest expenses on the debt, on the balance sheet. So if you have a company with a lot of debt, they will have to, one, repay their debt, and two, pay the interest. It will be a drag down on the profits. It will add more cost. It will reduce profitability for the business. Compare this with another business that has no debt at all, that is filled with cash. One, they don't have a debt to repay, so no cash outflows in the future. Two, they don't have interest rates to pay, interest expenses, so profitability is not down. And three, they can invest this cash. They can invest this cash in treasuries, for example, and get a nice yield. And fourth, they can do whatever they want with the cash. Having a lot of cash in your balance sheet gives you flexibility. You can seize opportunities if you want to make an acquisition. You can seize another opportunity if you want to buy back your own shares. This is why I said it depends on the quality of management. But if you've done the qualitative work, maybe you know one thing or two about the management team. You know if they are good about allocating capital, having the vision on the company, on the industry, and maybe they are good capital allocators, like they give dividends or buybacks depending on the price action. For example, if the stock price drops, you want to pounce on buybacks. Not a lot of management has done this. I can give you one ticker. A company that does this successfully is Medpace. Medpace Holdings. The ticker symbol is MEDP. Check on the internet. When the valuation went down, the PE ratio went down, they increased the buyback program by a lot. So this is a great way to create value for shareholders, and not a lot of management teams know how to do this. The key here is to spot management teams that are good at capital allocation. Even in the US, not everybody is good. So if you don't know how to do this, maybe you have to work on finding good capital allocators. You have plenty of videos on YouTube about this one. I've made plenty of videos on this topic. And again, we work on this on the coaching program. So as always, you have the link in the description. Track record of good capital allocation. Here we go. A conservative balance sheet will help you have more flexibility. That's a risk that you want to avoid. And also, if we are faced with a big financial crisis, having a lot of debt will not help you. And having investing in companies that are leveraged, if we are in a scenario like 2008, will completely destroy the stock price. So that's a risk that you don't want to take. Fourth filter, predictable cash flow growth. The best businesses are cash machines. I want stable, repeatable growth. Yeah, another way to put it would be avoid cyclical companies. Companies with a lot of profits for 1 year and then a lot of losses for 1 year. Profits, losses, profits, losses. We don't want this. I want to just have a simple investment thesis, right? Simple investments, simple companies, predictable free cash flows. For all the businesses I have in my portfolio, I know with good certainty what the free cash flows will be for the next 1, 2, or 3 years. After this, that's a little bit of speculation. But for the next 3 years, I have some good certitude. I'm pretty sure. For cyclical companies, oil companies, or anything that is cyclical, the car industry, for example, we have no clue. Nobody knows. Even the management teams, they don't know. So the goal is to invest in predictable free cash flow machines and companies that like growing their free cash flow per share. That will be another filter. You want companies to focus on free cash flow for shareholders. So, here is another quick tip. You can check the incentives of management on a document called the proxy statement, and you can see how the management is compensated. If the management team has a great bonus at the end of the year because they increase the free cash flow, this is nice. The incentives are aligned. The management will get a reward, will be rewarded if they increase the free cash flow. So, additionally, I most of the time invest in companies that are incentivized to boost the free cash flow. That creates an alignment of interest. Fourth filter, valuation below intrinsic value. Even the best company can be a terrible investment if you overpay. I only buy when the odds are clearly in my favor. You can buy an extremely good company, but if you pay too high a price, too expensive, you will have a terrible performance. The most famous example of this is Microsoft in 2000. Great business model, great management team, but a PE ratio of 70. It's just too high. So know yourself, know a threshold. I have, for example, for me, I have a threshold of a PE ratio of 30, 35, 40 max. I don't go above this, and I never went above this for my buy targets. So for me personally, I never buy extremely expensive businesses, even though there are great businesses, right? You want to buy fairly valued businesses, fairly valued stocks, or cheaply valued stocks. Either cheap or fair value. This is how I generated 25% per year. The investment thesis become way more simple. And if you accumulate all these points, high efficiency, a lot of moat, quantitative moat, qualitative moat, good balance sheet, no risk, long history, track record of free cash flow, and you buy at a fair price or cheap price, you increase your chance of outperforming the market. And this is what I teach my clients. By the way, if you want to join my community of serious investors and you want to become a better investor and outperform the market, there is a link in the description to book a free strategic call with me. So we will discuss, just you and me, discuss about your situation, your problems, your portfolio, and see if I can help you. And if I can help you, we will be able to work together and you can join us on our coaching program. So if you think that will be interesting to you, you can just click the link in my description to learn more about my coaching program and book a free call with me. And I'll see you on the other side.